Good morning and welcome to this Tuesday morning's Amati Insights call. And today's topic is to reflect a little bit on the budget from last week. And I'm here with my colleague Gregor Paterson. I'm Paul Jourdan. We together are involved in managing the UK Smaller Companies Fund at Amati. And we've been following events around this budget pretty carefully over the past few months. Just before we get going properly, you'll see there's a disclaimer slide at the beginning here. We're not intending this video to be financial advice of any kind, purely of interest on financially related topics. So let's get into the meat of this. Gregor, maybe we should start by just talking about the extraordinary build-up to this budget, which I know has been commented on quite a bit. It feels like it was very long, drawn out, had a lot of damaging effects. Just tell us what your thoughts on all of that have been.
Well, I think it was fairly unprecedented. I think the speculation started around about the second quarter. So really people have been trying to guess what was coming since about April. And we can see from this slide that employers really since about then have been putting off making any hiring decisions at all. Worried about the unknown, and during that time all these different proposals were floated via the media or via city economists, and there was even a pre-budget speech from the Chancellor to prepare us all for income tax rises, which in the end we didn't get.
Yeah, and there was I mean, I was thinking there was a definite repeat from the long process started with the famous black hole from last year, where we were being warned that we're going to have massive tax rises to fill this gaping black hole in the public finances. It was like deja vu all over again this year, wasn't it? Just waiting, how big is this black hole going to be? What's it going to take to fill it in? And then when we got there, what happened? Well, there wasn't really much of a black hole. And looking back, you're just thinking, what was going on here? It's worth interrogating this a little bit, isn't it? And so, well, let's look at a few more things to do with the budget, because they might show some answers as to what was going on. I mean, I personally think that if you stand back from the budget and say, well, what are the big features of this? Actually, much more than tax, which is what's being talked about all over the place. There's some new taxes and some sleight of hand here and there, which we can talk about. But actually, more than the tax side of it, the big feature of this budget was spending. And it's also the big feature of last year's budget. And so I guess one theory about what might have gone on is that she knew back in the summer that she was going to be forced into major spending increases that she didn't really want to do. And she probably would agree are not very responsible things to do. And therefore, she was slightly panicking, thinking, I'm going to have to raise a ton of tax to pay for it, not having quite figured out exactly how much that was going to be. And so maybe that explains this extraordinary journey we've been on. And I think what's pretty clear is if we go through this every year, then they are going to completely knacker the economy. So
I think you wonder whether they tried to, to fly every kite that they could, and all of the responses was negative, and in the end this was a budget that was driven by decisions that keep the government in place for now, and that this was the least bad of the options. I mean, I think it's worth remembering that all of the tax rises are so backloaded, they don't come in until 2029. The next general election will be no later than August 2029. So obviously they're hoping that they're not going to start 2029 in January by saying, oh, remember those tax rises that we promised you in 2025 before they start campaigning. So they have tried to push everything out to the right as far as they could.
Yeah, and probably, I mean, if the normal course of the political cycle goes, when it comes to 2029, the budget that is going to say, oh, we're going to do some tax cuts this year. So actually, I think we should be very sceptical about whether some of these tax things ever come into being. Just thinking about the gilt market, which are obviously one of the major constituencies for this budget, the audiences for this budget was the gilt market, and she made that very clear. It's abundantly obvious to everyone the lesson of the Liz Truss budget was you don't upset the gilt market. That was front and centre. So it's both made me think, one thing she did maybe quite cleverly in this budget was to slip in some measures that were clearly anti-inflationary, and particularly next year. And there's this rather nice slide actually in the budget document itself, which we can have a look at on the screen here, which shows their own assessment of exactly how much disinflation effect some of these things are going to have. And you can see here the energy bills package, the rail fares freeze, the fuel duty freeze. Those are all having a pretty helpful impact on inflation next year. And that then brings down inflation expectations, which helps the gilt market. So if you talk about a couple of slides on the gilt market.
Yeah, sure. I mean, let's get into the positives. So the positives were that they increased the fiscal headroom to 22 billion, up from less than 10, and I think that showed the bond market and our creditors that they are starting to take this seriously. And you can see here the reaction over the week. The 30-year bond yields did fall, and here it is over the year, and you can see the spikes where there have been potentially the start of what we now call these mini fiscal events, in which we seem to have avoided that and given the bond market a bit more confidence that the government is focused on sort of rebuilding our reputation and being making fiscally credible policy decisions.
Yeah, absolutely. So we've had a good response from the bond market, I'd say, to the budget, or a neutral response. And I suppose another way of looking at that is, unfortunately, that the bond yields, well, they reacted very sharply to the change in TAC over income tax rises, and well, they have maybe now retraced to the level they were at before that announcement. So that overall that's been a positive response. But we haven't yet broken out of the ranges we've been in. So actually, a lot of the real test of this budget is going to be whether we see rates come down next year, and helped by that disinflation that's been pumped into the system, at least for the next 12 months. And yeah, I think that's fair enough to expect we're going to see some of that. Just before we come back to that point and how that might have impact markets, talking about spending, there's a few pictures which illustrate the spending side of this budget pretty well. This first one here looks at the projections of total departmental spending. So this is what the ministers are merrily spending away each year, and it's comparing the spring budget of 2024 with this budget of 2025, and you can see that this is pretty massive. And in fact, the spending has gone up above the COVID level of spending in 2020. So I think this is quite salutary. And then we have another way of looking at this. They produce 4 measures of public sector balance sheet. There's a lot of fudge that goes on with all of these measures, as we know, but I'd say the most important one here is probably the public sector net debt figure, which is about 95% at the moment. It's important to bear in mind when we look at that it doesn't include unfunded pension liabilities, which probably add on another, say, 50%. A slightly intangible number, and it's slightly anybody's guess number, but let's say 50% to that number. So public debt is really at a very high level, and I haven't met any economists who argue with that. And one other way of looking at this, and this shows the impact, some of the sleight of hand in this budget to do with spending. This slide here from the Institute for Fiscal Studies shows that in every year of the Parliament, so out to 2029 to 30, as a result of this budget, every year spending has gone up, and then it magically catches up just after the end of the Parliament, and suddenly we get a bit more headroom, but that's only appearing in 2029, 30. It's enough to be a pretty fanciful number. But every period that we can kind of have a bit more of a handle on in the next 3 years, spending's gone up. So that's the position we find ourselves in. Just very quickly, tell us a couple of things how you think markets might respond in the next few months to some of these events.
Well, that's the punchline for us, and I think what does this mean for the markets? Well, as you've said, it's less inflationary. There was no big NI increase. That definitely clears the way for the Bank of England to be able to cut rates. when rates in the UK go down, small and mid-cap equities go up. Here's a slide that shows the house builders and the real estate sectors, and you can see how correlated they are to interest rate decisions. There's now a 98% chance that the next Bank of England decision will be a cut, and I think there'll be several more after that, and that really should help start to restore confidence in the UK equity market. Remember, we're on a PE of about 12 times, roughly half of small and mid-cap companies in the US. We've now got a more fiscally sensible policy that the bond markets have so far given their backing to. And I don't think it'll take too much more before people start to reassess, the UK stock market as a potential safe haven place to look to invest some of the money.
Yeah, I think that's right. And we get asked a lot. I mean, most small cap fund managers like us, UK small cap fund managers, are thinking, that the valuations in this market are so enticing. The opportunities look fantastic, but what's the catalyst going to be? What's going to stop the big outflows from the London stock market, and particularly at the small end? And you never know the answer to that. That's the problem when markets are beaten up, as ours is, and it's been pretty extreme in the run up to this budget. What's the catalyst going to be? And clearly, the rates finally falling in the way we thought they were going to much more a year ago, and the bond market yields coming down, rates falling, that may just on its own be enough to really start to change the mood. I mean, there is a sense of as soon as these fund flows, liquidity flows, which are at the moment are negative in the market, start neutralizing and maybe even turning around positive. This feels like there's a lot of dry tinder around that could catch a light pretty quickly. So that's what we are hoping for next year. I think we've probably run out of time there. Thank you for joining us. I hope that's been interesting. Thanks, Gregor.
Thank you.